Okay, welcome. Some of you know that this is the last class in the semester for a new course we initiated this year called Accounting for Real Estate Investment. And I was one of the co-adjunct professors. Ed Leva is my name. I'm a partner at KPMG and also an adjunct professor here and over in the law school. And I was joined in the course by Christina Parker, who's to my right here, who is also a partner at KPMG, and Ben Carr, who's Vice President of Investments at CubeSmart, and also one that isn't here, Rob Levinsky. And the course, just backing up before we get into a brief description of it, was really the genesis of Dan DiLella Center for Real Estate. And Jessica Taylor, to my left here, is the director of the program, along with Sean Houghton, professor of finance. They're really the movers and shakers behind that advisory committee. And as soon as I told Jessica about the fact that for our final class of the semester, we would have this prestigious panel of CFOs from the real estate community, she said, oh my gosh, we have to open this up to the Real Estate Society, and then word filtered out, and the accountant said, well, we have to open this up to the Accounting Society as well. So that's why you're all here. A brief description about the course. As I said, it was the first time this year, and it was really designed to follow the life cycle of real estate from entity formation and the type of entities that you see out there in the real estate investment world, sources of capital, and the 9 of the people in the class here could probably tell you all about this as well. But then after we discussed the sources of capital, then we went down the path of the typical life cycle of real estate, from acquisition to development to operations and ultimately disposition. And through each of those stages, we talked about the accounting and tax issues associated with it. And then we wrapped up the last couple classes with just some of the issues related to financial reporting for REITs as well as funds, which are the 2 primary vehicles for real estate investment. So, class did a pretty good job of what we talked about. Did I miss anything? Okay. All right. So our class tonight, as I said, was designed to bring in some CFOs from local real estate companies here that I'm sure you all recognize. So first, let me introduce our panelists, and you'll see that we have a very good representation, not only from companies, but also from industry sector, as well as universities. So to my far right is Chick Boyle, who's the Vice President and CFO at Universal Health Realty Trust, and a proud alum of Villanova. Next is Bob McCadden. He's Executive Vice President and CFO of Pennsylvania REIT, or PREIT. And Bob is from Temple. And then we've got Pat O'Grady from LaSalle, and he is the CFO of Morgan Properties. And then we've got Tim Martin representing Penn State, and he is the CFO of CubeSmart. And then finally Eric Emmerich of Blue Hen from Delaware, and he is the CFO of Independence Capital Partners and Rupert Adler Real Estate Funds. So I'm going to start out first by having each of our panelists discuss very briefly their company, the segment that they're in, maybe the relative size of their company, and anything else of interest that they'd like to share with you in terms of the profile of the space that they operate in. And then from there, we're going to follow the life cycle, as we did in the class, and really talk about some of the issues related to capital formation and then getting into the actual life cycle. And then the best part of the night that I'm anxious to hear is I'm going to ask each one of them to really trace their steps from college all the way to where they are now. So you'll all get a flavor of what the path is to reaching this esteemed platform of being a chief financial officer of a real estate company. And then, of course, throughout the entire panel presentation and conversation, we want it to be a conversation. So I encourage you and I'll offer our students extra credit if you have questions. So we'd like it to be obviously some form of a dialogue, and I think once we get into it, you're really going to hear some interesting stuff. Okay? All right, Chip, start us off.
Thank you, Professor Leva. As Ed had mentioned, I am the CFO of Universal Health Realty Income Trust, which owns acute care hospitals. The real property of the acute care hospital is a behavioral health facility and primarily medical facilities. Universal Health Realty Income Trust is advised by Universal Health Services. Both companies work out of right down the street in King of Prussia. Universal Health Services is a hospital management company. We own 25 acute care hospitals, and now we're up to over 200 behavioral health hospitals. We have about $7.5 billion in annual revenues, and that's an operating company that, in effect, owns and operates hospitals. UHT, which is the trust, owns the real property of a few of those hospitals, but for the most part, the majority of our business now is with third parties that are affiliated with UHS, primarily in the medical office sector.
Good. And just the 9 from the class know this. Probably most of you also know this, but the 2 main vehicles for real estate investment in today's world is either through a real estate investment trust or through a real estate fund. And so we've got both sectors of that represented here with 4 CFOs from REITs and 1 CFO from a fund. So that was notes down. Okay.
Outnumbered 4 to 1.
Yeah. Okay, Bob.
Okay. I'm with Pennsylvania Real Estate Investment Trust based in downtown Philadelphia. We focus principally on retail properties, primarily shopping malls. We own 38 shopping malls, enclosed malls, and 8 open-air centers. We have 8 of the malls here in the Philadelphia area. You might be familiar with the Gallery in downtown Philadelphia, Cherry Hill Mall, Plymouth Meeting Mall, Exeter Mall, as well as some others. By size, we're about $3 billion in assets. We have about 33 million square feet under management. We do a little bit of third-party management for other owners. That's not really a big part of our business. But our claim to fame is that we were one of the first REITs that was founded in 1960. So a few years ago we celebrated our 50th anniversary, and now we remain the second oldest REIT in existence. Everybody else who was formed before us either merged or was acquired at some point over that period. And the other interesting part is that we only have, in our 52 years of operation, we recently, earlier this year, announced our 3rd CEO. So we've had some pretty good continuity with the first CEO from 1960 to 1997, second from 97 to 2012, and our 3rd CEO. I don't think plans to stick around for 30 years, but that's a brief synopsis of REIT.
I'm Pat O'Grady, CFO with Morgan Properties, and we are in the multifamily sector. We own apartment buildings. We are not a REIT yet. We're actually sort of straddling the space between companies like Eric's. So we've been funded by opportunity funds throughout our history, and we have filed an S11, a registration statement, to become a REIT, but we have not completed that transaction yet. So our core business is apartments, and we don't develop. We buy and hold. We still have, Mitch Morgan is the CEO, and we still have the first asset that he bought in 1985, and I'm guessing that there's at least some people on this campus that have been at parties at Kingswood Apartments, and that's sort of the flagship. We do know that we have a high degree of Villanova students concentrated in that apartment, as do some of the other residents as well. We own, our marketing people say that we own 26,000 units in 10 states, but the reality is that 83% of our business comes from suburban New York, suburban Philadelphia on both sides of the river, and suburban Baltimore, D.C. corridor. And it's a pretty simple business, right? I mean, if you put the right debt in place and you have the right ownership structure, you collect rent every month. We don't have the same kind of risks that others in real estate do with long-term leases. Our leases generally are a year. They don't all turn at the same time, so we have about the same rollover every month. So that does 2 things. One, it limits our risk, and it also presents the opportunity in an increasing rate environment, that we can capture that as quickly as possible. And then we have a pretty basic cost structure. You know, we pay real estate taxes, we pay utilities, we have payroll, and then we have services that we provide to the residents, as well as repairs and maintenance and turnover costs and things like that. But it's a pretty simple business. You know, when we went through the downturn, because of sort of the lack of volatility in our space, while our NOIs went down, we actually never went below zero. And there were markets for the multifamily sector in other parts of the country where they actually dropped. So NOI went from, you know, X down by 8 to 10%. Ours stayed flat during that 08 to beginning of 10 period, and we like sort of the stability of we attribute that to sort of the stability of our resident population, our infill locations in those suburban big city areas, and the fact that, you know, we can react quickly to changes in the market and then structure our business accordingly.
Excellent, thanks. Okay, Tim.
My name's Tim Martin. As Ed said, I'm CFO at CubeSmart. CubeSmart is a real estate investment trust traded on the New York Stock Exchange. We are focused on owning and operating self-storage facilities. We do have a national footprint. We either own or manage for others properties in 26 states plus the District of Columbia. I would echo and characterize self-storage similar to multifamily, as Pat said. We have shorter length leases, which create a lot of the simplicity that he alluded to. On the other side of it, though, by having such short leases, it means we have, if multifamily is a 1-year lease, our leases are 30 days. So on the scale of real estate, you go on one extreme, you have hotels, which are 1-day leases, all the way up to, you know, more Bob and office companies who on average would have 7 to 10-year leases. So you have a lot of the advantages that Pat alluded to in our business as well. The complexity that it adds having such short lease periods is that we need to fill up spaces all the time. So if our average tenant stays with us for about 14 months, even though there's a 30-day lease, they stay about 14 months, versus in an office building, for instance, you only have to interact with the customer and make a sale every 7 years. So while there's simplicity from a capital structure and a risk management standpoint, I think the complexity that folks might not think about initially when you think about contrasting the different product types within real estate is we're much more of a business to consumer model. So we need to have a website, we need to attract customers, we have an awful lot of intense data analysis internally that makes that part of our business more complicated. So it's an interesting trade-off. We're located just down the street in Wayne, Pennsylvania, where our corporate headquarters is. We have about $2.6 billion is the value of our asset base. And we have just over 1,400 employees.
Eric.
I'm Eric Emmerich. I'm the CFO of actually 6 family of funds, but only 2 are real estate related. The biggest of those is Leeward Adler Real Estate Funds. And we're an opportunity fund. We've raised about $6.5 billion of commitments over the last 13 years. As an opportunity fund, we invest in just about anything closely related to real estate. So we're in industrial, we're in office, we're in obviously multifamily a lot. Each fund tends to morph to where we really think the opportunities are at that particular time. So we're headquartered in Philadelphia. We have offices in New York and Atlanta. And again, the other real estate fund I deal with is LEM Real Estate, and that's a preferred equity or mezzanine, mostly in the multifamily space.
Okay, so this is good. And again, the 9 members of our class are pretty familiar with the various sectors because their favorite part of the class was every week they would report out on what was in the Wall Street Journal property report. So over the last semester, they've become familiar with the various sectors as represented by all of you, as well as REITs and funds. I misspoke when I said Morgan Properties was a REIT, but we're getting close, maybe. But this is a good place for us to start. So as we started in the course, we talked about capital formation And with REITs, it's the public markets. And we talked about those formation transactions that occurred a number of years ago where you take privately owned real estate and roll it into a REIT. So Pat's right in the middle of that. So maybe, Pat, we can start with you, and to the extent you are able to discuss aspects of the IPO process for a REIT. And then I'm going to come to you, Bob, because I know you have a wealth of experience in terms of going through a couple transactions in the past, and maybe we can give them a little bit of a flavor of what really occurs in the trenches, what's involved. So, Pat, with you, you got a private owned property, you want to get it up to the public level. What happens from soup to nuts?
Yeah, I guess historically we've been financed, and we are, in our world, we are high leverage. We're a high leverage shop. We like leverage, and we've been very successful using leverage, partly because the primary source of debt capital for multifamily operators are Fannie and Freddie. So they are the GSAs, government-sponsored. I don't even know what GSA stands for. Government-sponsored agency, right? They provide debt capital and pretty much are one of the few lending sources that will go up to 80% leverage. So our historic model is 80% leverage provided by either Fannie or Freddie. You play them off against each other to get the best deals. And then we have gone to opportunity funds like Eric's. We've used Berwyn Capital, Berwyn Property Group. We used Capmark, which was formerly GMAC. And then we used AIG Global Real Estate. And that one is a whole other story. That we could sometimes we care to relive, sometimes we don't. And we looked at the IPO process, not so much, if you look back historically over companies that have done an IPO, certainly from the 90s on, a lot of that was driven by stress from their debt structure. We don't have that stress, but we've looked at it as an opportunity where we've seen the amount of capital that can be raised literally on an overnight basis. One of our competitors, AVB, last year raised $700 million overnight in order to complete, like a $4 billion transaction. I mean, it would take us years to raise $700 billion. And we viewed that as, our scale is probably about $2.5 billion in assets right now. We viewed the IPO process as an opportunity to significantly increase that. In the last year we bought 2,000 units, but when you have 26,000 units, adding 2,000, while it's a lot of work to do that, really doesn't move the meter in terms of growing your company. So you need access to bigger chunks of capital, and as you look for bigger chunks of capital, the opportunity, the number of sources that have that capital shrink. So that's why we were looking at the IPO process, and to get into that is a very there's tax implications in terms of how to structure it, because a sponsor usually is historically it's been a family group that is heavily invested, and real estate assets tend to decrease in basis, so you have significant tax implications depending upon how you structure it. So that's a complication. We had been a shop where our different investor groups had different accounting bases. So Berwyn Property Group, for instance, required us to keep tax basis financial statements, not to do any GAAP financial statements. AIG was an audit shop. So we had, as we try to put this portfolio together, we never really looked at it as one company. We looked at it as individual portfolios of assets dictated by the needs of the investor group. Now we had to put this all together. We had to go back through, literally back to inception, in order to build up the GAAP basis for some of these assets. And these are acquisitions that we did in the early 90s. We had, we had purchase accounting that was done under APB 16, under FAS 141, under 141R, under 141RR revised. That was a very complicated process. And then there was all the legal and SEC requirements that were necessary, the information that the underwriters required, because that book that you put together, the prospectus, is basically your sales document. So if you want to make any statement as you go through your roadshow when you're selling the stock, you have to have that information available for the SEC to review and in that document somewhere. So and that process to date has cost us about $5 million. and we don't have a completed deal. So it's time consuming, it's expensive, it can cause you to take your eye off the ball. I mean, one of the things that we were very concerned about was not to lose sight of our day-to-day operations. So we had a core group of people that worked on that transaction, but it didn't extend to the entire company as a whole getting bogged down with it, because we needed to, it really doesn't make sense to take a year off, do all this work, and then have operations go in the tank, and then you've lost your story. We still look at this as an incredible source of capital, but a lot of the institutional investors, when we started this process, the institutional investors were more interested in Class A apartments than Class B, which is our shop, is primarily Class B, built in the 60s and 70s. And a lot of those institutions have now started to look to B. They think that A is overpriced, and they're looking to B. So we don't have the same pressure right now to complete the transaction, but it's still on the shelf. And I think at some time we complete that transaction. I just, I don't think it's going to be in the near term.
The interesting thing, hearing Pat's story, and Pat and I in a different time period we're colleagues together, but the interesting thing is companies that are private like his and are looking to expand see the public markets as a panacea, because in economic times like we've had over the last few years, to some extent, private companies have been locked out of the capital markets, and there's really the REITs who were the first entrance back into the capital markets, either from a debt or equity perspective, and really opening up the markets. And today, I think it's probably a little bit different. But during that same period when Pat was trying to go public, we as a public company were saying, the public markets look at us on a quarter-to-quarter basis. Real estate, particularly in our sector, regional malls. I mean, these are, as Tim mentioned, we have 7 and 10 year leases. So in order to do certain things, and if you want to reposition a property, it may take 3, 4, 5 years to do so. And what it means is you're taking some of the tenants offline with the hope of bringing in a higher quality tenant, paying higher rent, but that might not happen until years 2, 3, or 4. So what happens is all of a sudden your NOI, which had been growing, either stumbles or maybe declines, and the investors flee your stock. So at some point, our stock, probably from 2007, we were probably trading in the mid-50s. During the depths of the financial crisis, we were trading below $3 a share, and that experience is probably shared by others, maybe to a lesser extent. So $3 a share, the private value of that enterprise is $20, $30, and so it becomes an interesting question. Should we, in effect, take the company that was otherwise public and go private, where you're not faced with the same quarterly earnings pressures that private companies have? You can maybe take a longer-term view, but when push comes to shove, ultimately the flexibility of having that access to multiple sources of capital, and we did a couple of preferred share offerings this year, raising $200 million, 125 earlier in the year and 75 later in the year, and literally you pick up the phone, you call your attorneys, they come in, do some due diligence, you hire an underwriter, they send their attorneys in over a couple-day period, you print a prospectus, you don't even, today for that type of security, we didn't have to go out and market. The first deal we did what they call a net roadshow, which is essentially a audio cast with a PowerPoint presentation where investors can call in and listen to a management presentation that is probably 15 minutes in length. But in a heartbeat, you put $200 million of new capital on your balance sheet, which, as Pat alluded to, it's hard to do as a private company. So, in my experience, and this primarily not on the company side, but in my prior life I was on the audit side, having worked with a number of companies that went public. And I think the point that Pat raised, which I think is probably one that really affects companies a lot, is taking your eye off the ball, because your process has been, a couple years in duration? And you think about all the challenges you have in any business and trying to manage day to day, and meanwhile, you got to keep marketing the properties, you have to keep leasing them, you have to go look for financing, and these things take time, not only the lower and middle management folks, but also senior management. So the important thing is having enough talent to pull it off. The other big challenge, quite frankly, is until you really cross that Rubicon from private to public, there's a big cost of being a public company. You think about, you have securities attorneys, you have maybe specialized accountants in your shop, you have an investor relations function, there's a lot more costs, you have independent trustees, directors, board meetings. Some of that occurs in the private side as well, but much more intense on the comp consultants today with a focus on executive compensation. And so the question is, at what point, Pat spent $5 million so far. At what point do you start making investments in those public company infrastructure elements before you're absolutely sure that you're going to get there? And sometimes you might not get there because the market closes on you. Other times you might not get there because you conclude, you know what, it may not be worth the effort to be a public company that can find source of capital and continue to thrive as a private enterprise. And just in terms of, and I had worked with Christina as well on taking a company public, I guess it was probably about 10 years ago. And that process it was a multi-stage process. Initially, in year one, they went out and did a private placement with qualified equity investors so they could go out. I think they raised about $400 million. Initially it was a business. They're a company called American Financial Realty Trust, again based in Jenkintown, Pennsylvania. Their business model before they went public is the CEO was very entrepreneurial. He had a couple of different companies. This was his first real estate venture, and he's got started in business when some of the banks in the areas were consolidating their branches. They were closing bank branches, and they were effectively selling the bank branch real estate at bargain sale prices. If you think of a typical bank, that has billions or trillions of dollars in assets, the bank branch is really inconsequential. They probably have a couple $100,000 invested in it. Maybe it's worth $500,000, $1 million, $1.5 million, but it's not part of their core business. So when they decided to exit the real estate part of the banking business with the branches, they were effectively selling these things at a significant discount. So this individual basically raised money. I think he raised probably $2, $3, $4 million from friends and family. Went out and bought portfolios of banks that were being divested by larger banks. He would take those banks, release them to smaller banks that were looking to expand or convert them to a Dunkin' Donuts or an auto repair shop or whatever. But in a matter of a couple of years, he had doubled his investors' money. So all of a sudden, almost was a serendipitous discussion with an investment banker. An investment banker, this was the folks at Friedman, Billings, and Ramsey down in Washington, D.C. They were coming up with a lot of specialized REITs and niches. And they were talking about, with all these banks divesting branches, maybe we should sponsor an operator to go out and acquire all these branches and do effectively a roll-up. And meanwhile, while they were talking about this down in Washington, there was this guy out in Jenkintown already doing this. So somehow they got connected, and Friedman, Billings, and Ramsey took this investor out, and they were going to raise about $100 million. They thought that was a nice round sum of money to go out and do this. Well, they were met with such institutional investor interest, they ended up raising in the initial private offering about $400 million. And all of a sudden now, they became a real company. They were able to buy hundreds of branches at a time from places like Bank of America, Wachovia, and others. And all of a sudden now, they were on a track to becoming a public company. And what did they have? Maybe a dozen, 20 employees? And so all of a sudden, they were 12 months away from being, a billion-dollar company. And again, much like the experience at Pat, where they didn't know GAAP basis. They was a tax basis shop, private investors. Everything they did was on a tax basis. The notion of what GAAP accounting was pretty foreign to them. So they really had to start almost at the basics. Converting their books from a tax to GAAP basis. And over the course of a year, they continued to go out with their $400 million and buy additional assets, and it was really a very interesting time for the company. But really, I guess it was about from the private placement to their going public was about a little over 12 months. But they were basically over a relatively short time frame, instantaneously a billion-dollar plus company. And this was from an entrepreneur who didn't even have a real estate background, but he was a deal maker, saw a niche and an opportunity, and was able to convert it to a very successful business, which ultimately, what he forgot as an entrepreneur is that if you build a business that was, I don't know how big it was at its peak, several billions of dollars, then you actually have to build an infrastructure to run the business once you build it. And they run into a little bit of trouble after they built it and ultimately sold out to another operator. But the same guy is now back in business, raising money in the private REIT market, which is a whole different area of the capital markets, and he's been very successful. He's probably now the largest
He's
capital raiser.
he's the king of the non-traded REITs.
King of the non-traded REITs. I don't know how many he has, but he has a platform that raises billions of dollars each year and deploys it into different property types.
And the footnote to that story is Bob ended up being on the balcony of the New York Stock Exchange where they ring the bell with the CEO and the primary.
No, it actually wasn't me.
Oh, wasn't you?
No.
You up there?
We were invited up.
Scratch that? Wait,
No,
it was on tape.
It was my 8-year-old
Yeah.
daughter.
Oh, okay. All right.
Just a quick aside. The company was very good in terms of trying to involve professionals, the accountants, the lawyers. They all worked probably thousands of hours to help this company go public. And the CEO invited all the participants in the IPO process, or at least some of them, up to the New York Stock Exchange to witness their opening bell ringing ceremony. And so I received an invitation, and my wife, at the time, we had a young daughter. My wife was out of town in Washington that day, so I called the CEO up and said, "Nick, I'm very flattered by your invitation, but I'm not going to be able to make it. My wife's out of town. I have to, be with my daughter." And he said, "Bring her up." He had a daughter about the same age, so we go up and had a nice dinner the night before. We had breakfast at the New York Stock Exchange boardroom, and my daughter starts playing with the CEO's daughter. And so a woman from the stock exchange comes over, and we're going to go down to the floor, get a floor tour before the bell ringing ceremony. And the last thing my wife said to me before I left is, "Whatever you do, don't lose Jackie, my daughter." I said, "How can I lose my? She's going to be with me all the time." So we entered the floor of the stock exchange, and one of the representatives from the exchange comes and takes the two girls to take them on a different tour. And all of a sudden, you approach the opening bell, the floor gets crowded, all these traders are running around. I look around, my daughter's gone, right? So I'm panicked. I just hear my wife's words like in the back of my head saying, "Don't lose your daughter." How am I going to go
Father
back?
of the year.
Yeah. How am I going to go back and tell her that? Well, now the clock's ticking to the opening bell. I look up, and my daughter's up on the balcony with all the company executives. She and I guess her newfound friend. So she actually had the experience at 8 years old of having been up on the podium ringing the stock exchange bell before I ever did.
Okay. Good deal.
Can I pile on for a second?
Sure, pile on. Yeah, that's what.
So I would pile on to what both Pat and Bob said. A lot of REITs become REITs not because they want to, but because they have to. Pat alluded to the fact that he's in a position at Morgan where it's a choice. It's not a necessity. They don't have any hardship. They're not trying to solve a problem. Many REITs become REITs because it's one of two choices: sell or go public to be able to take out an existing partner, restructure debt, something like that. Our company, Ben and I, was founded in the 80s. It was a private company in Cleveland. Went public in late 2004 because it had to, not because it wanted to. And so it was a family business that was accustomed to being a family business. Unlike what Morgan Properties is doing, which would be recruiting somebody like Pat who has public market experience to come in, build a team of people who have public market experience, and then go through the process and spend money. Our predecessors at CubeSmart, formerly Ustorit, didn't do that. They had investment bankers come in, prop up the company, took them public, thrust a lot of money upon them, not all that different than AFR. And the result was, within 5 quarters, they had effectively run the company into the ground from the standpoint of the public marketplace because they didn't have anybody on the management team that had any public company experience. They didn't have anybody from a back office standpoint that knew what it took to run a public company or how to communicate with investors. And they really treated the company like it was still their own family business. So the result of that was the board looked to bring in a new group of folks to get the company moving back in the right direction. That's when I joined. That's when Ben joined. And Ben and I spent the better part of about 90 to 120 days restating every financial statement the company had ever done dating back to their IPO, including audited financial statements. So there's a right way to do it, which is what Morgan's doing, and there's a wrong way to do it, which Ben and I had the joy of trying to clean up after. But it is a bit, there's a $5 million cost that Pat talked about and some of the other stuff. The biggest cost to many folks who go to the public structure is a change in their culture. Because most real estate does start with an entrepreneurial spirit of deal makers. And you take deal makers who want to go out and do the next real estate deal, do the next big lease, do the next thing to make a good long-term decision. And now you take those same folks and thrust them into a whole different role, which is having to be on a quarterly earnings call, to be able to be mindful of results every 3 months. Not a good decision for 4 years from now, but you have to answer questions then as to how does this impact the share price tomorrow. So you get thrust into having to still run the business for the long term, but be able to communicate it and deal with a lot of constituents who want to talk about it on the short term. And for a lot of entrepreneurial real estate people, that is a very difficult, if not impossible, transition to make. I know Pat has a near and dear experience in his past that had a very entrepreneurial leader of a company. It's just a hard transition to make. Ultimately, for our company, all of those folks in the family ended up stepping aside, and a whole new group of people who came in who were really brought in and had the experience to be in a public company structure.
Eric, you were gonna?
I have 2 questions for Pat to keep this, since the questions are flooding in from now. You're raising a REIT, right? So
Right.
are you going to use an UPREIT structure?
Yes.
And second, has the Jobs Act helped you at all? Because it hasn't really
No.
helped us at all.
The Jobs Act has
Okay.
had no impact on us, partly because I think most of those provisions are for companies less than $1 billion, and we're over $1 billion at this point. And Eric talked about the UPREIT structure, and UPREIT, all of our holdings right now are in individual partnerships. So an operator, we are the operator. We would go and get an investor like Eric. I keep coming back there. I thought you were going to ask me whether you could invest in our property.
Well, you know,
Yes.
we've been dancing that
I've been waiting.
dance, you know.
I didn't want to come out and
Something will have to
be that bold,
A
but
share subscription.
Right.
Or
I have a sales document available.
You in a quiet period?
you forgot to get the disclaimer if you're selling, Pat.
Right. The UPREIT structure is designed to enable, I talked at the beginning about all the tax implications. And one of the tax implications, obviously, is that if you have a low basis asset, which you contribute in, and you don't do it the right way, you can have a huge gain that is going to require a cash settlement with the IRS, and yet all you're getting is, you're not getting dollars, you're getting an ownership in an entity. So if you were to contribute your properties for shares directly in the REIT, that would be a taxable
Exchange,
event.
right?
So the structure was set up that another partnership is formed. The REIT investors, the public investors, contribute cash into the partnership. We would contribute our properties into the partnership, and that would be essentially a like-kind exchange and would not be taxed. So you still end up with your interest being a low basis, but you have the opportunity that you can trigger the tax whenever you want to, which is, and you would trigger that by converting your partnership units into REIT shares, because they trade at exactly, on a pari passu basis. And our CEO, who obviously has the largest portion of our equity interests, is going to pursue the ultimate tax opportunity, which is to die. Everybody's got to do it, and as long as you hold your partnership units until the date of death, you're immediately stepped up for your heirs, and your basis goes to whatever the fair value is on the date, and then you can effectively convert those into REIT shares with no tax at that point. So
Under current law.
under current law, right?
He missed his opportunity, wasn't it, what, 2010 or 2011, there was no estate tax?
It would have been better for him to have done the REIT in 2010 and then died by year end, but he didn't want to execute on that. I presented it as a viable strategy. He didn't want to execute.
Who was the successor?
I was going to take a fee for that brilliant advice, but
His wife had
he
the
didn't
same
go.
idea, but
There's a name for taking a fee for executing. There's a question here.
Yeah, to jump on the comment about the Jobs Act, if any of your ownerships or yourself had the Jobs Act when you started your company, would you have taken that route, being that the number is now $50 million per sponsor per year? Or do you see it as really a trouble area, because you can essentially write an offering document that says, we're going to make money somehow, we don't know how, take a guess?
I haven't really thought about it. Since it didn't, I haven't spent any time thinking about it.
Well, the bigger picture issue I see is that after all the things we've gone through with Sarbanes-Oxley and trying to tighten up disclosures with Dodd-Frank and everything else, all of a sudden now we give some people the opportunity to get into the public markets without the discipline and structure of a real public company. And I think that's a little bit frightening.
But I would tell you, when we have institutional investors like AIG, like Capmark, like Berlin Property Group, potentially Liquid Adler, you know, those guys just don't give you the money and let you go away. I mean, I've been a CFO of a public company as well, and what I was excited about going from public to private was that I wasn't going to have to deal with quarterly calls. And the reality is AIG had more analysts and a research department, and they had a partnership agreement which basically says that I had to respond to any reasonable request at any time. So the notion that private companies or smaller companies, you know, so below that $1 million level, they're just raising 50, don't have to, I mean, you will not be able to raise the next 50 if you don't have the ability to take the first 50, do something with it, and report what you're doing and demonstrate that you have management skills. So my advice, I don't care whether you're subject to Sarbanes-Oxley or not. Now, you don't have to go through all the compliance issues with Sarbanes-Oxley, but we have a shop that can get the right answers, that we look at the data. You know, Tim talked about all the types of metrics that they use to manage their business. I would venture to say whether they were funded by public equity or by private, that management team is going to have the same tools available because that's what you need in order to manage your business. So there's an element that adds on in terms of the cost of being a public company. But I think any company, if it's well run, is going to follow, you know, the same basic framework for how you interact with investors, regardless of who the investor is.
Okay, let me stay with something that you guys just brought up. We hadn't planned on talking about the investment banker's role in this process. But that's one element of the food chain we don't have represented here. But maybe we can just stay a little bit with their role during the process that you're going through, Pat, during the process that you've gone through, Bob, and then and pile on too, and Chick, you're through a secondary. There's a little bit of a different flavor there, but maybe you could share with everybody what really the investment banker does. We're on tape, so be careful what you might say about our friendly bankers.
You know, our investment bankers, I thought were very helpful, and we had four. We had B of A, Goldman Sachs, Morgan Stanley, and J.P. Morgan, and some more than others. And they each had their strengths and weaknesses. But there are a couple areas that they really helped in. One is sort of understanding the mindset. They, you know, our lead investment banker at Merrill Lynch was a guy named Jeff Horowitz, and I've probably known him actually since Brandywine days in '96 was probably the first time I met him when he was at Citi, and then he went to another place, and then he ended up at Merrill. So they move all around like other people do. But he was very good at, he spends half his time with investors and half his time with prospective companies that want to go public or clients, existing clients. And what that does is sort of give you a vision into how the investors are looking at what they're looking for. So that feedback in terms of structuring what our pitch was, because at the end of the day, I mean, it's all very legalistic and there's a lot of accounting data, but it is, at the end of the day, a sales document, and you are developing a pitch, and you have to refine it and make sure that your points are, you know, cogent, concise, that they hit the mark, and that they resonate with the investor group in order to get them excited so you can drive the kind of volume that you want. And then there were other guys that were, you know, really good at, you know, sort of just the business of putting this all together and you know, slogging through the document and making sure that things worked and helping you, you know, looking at your models so that they could provide feedback. So there's an analysis side to that. At the end of the day, these guys only get compensated if the deal is successful. So they are the one group out of everybody else, the accountants, the lawyers, everybody else takes their fee. What's that?
Not if it's successful.
If it's closed. That's my definition of success.
What is that? What is the amount of compensation?
Our raise was going to be $800 million, and our bankers were going to take 56 of that. So they're, you know, well compensated, but they also fronted costs too. Their SEC counsel, I'm sure, took a haircut on their fee when we didn't get closed, but they incur costs along the way. So there is an alignment of interests on that side. Whereas when I go to my other professionals, the accountants and lawyers and tax advisors in the group, they get paid. They need to preserve their independence. They need to. Their view of it is that they are not on a successful deal basis or a completed deal basis. They are on a as time is incurred. So that's where the sort of the $5 million bucket comes from. But the bankers, were very helpful. And there's you always get into disputes about things because they will tell. The one caveat that I will put to that is they want to sell this the easiest way possible. So all they want you to do is look exactly like the last successful deal that came out. And to the extent that you want to do something a little different, even if it's been your established business practice and you think it's the right thing to do, they are going to try and cram you into the last successful box because it just makes their life easier. And even if you're making $56 million, would you rather work hard for $56 million or would you rather work a little easier? I mean, I'd rather work a little easier too, but that's not always to the benefit of the company.
So real quick, for those without a calculator, I think that's 7%, which is
7%.
the standard rate for investment banking. Also, during one of these IPO processes, Pat just
We actually got that down to 6.5 because it was such a large deal, and they acted like we were stealing, the last breadcrumb off their plate. But yeah.
That's how you negotiate.
And then he referred to the Underwriters Council. So the typical team is not only the issuer, which is Pat's company, but then his set of auditors, and then you've got the issuer's attorneys, and then you've got the underwriters, and then you've got the underwriters' attorneys. So it's a whole gaggle of professionals, and it's a fire drill night after night during the closing hours of the closing before it actually goes public. But then it's usually a very happy event afterwards. So
The other thing I would add is that in the REIT space, probably less so today, but there is a group of investors that are referred to as the REIT Mafia. It includes companies like Cohen and Steers, Fidelity, companies that have typically been investors in most of the REIT IPOs as well as ongoing operating companies. And the kind of trying to mold the companies into a certain format, as Pat described, is really a function of, to some extent, that's what the investors want. While we all have unique stories to tell, and we think our business model is better than the next guy's, investors are generally lazy, and they don't necessarily want to make they don't want to invest the time because they're looking at hundreds of companies every day to potentially invest in, and they want to find a story that's easy to understand, easy to sell, because typically you're dealing with a research analyst who might be talking with a portfolio manager, and so everybody who has to tell a story has to be able to do it in almost like an elevator speech. I only have 5 minutes. How can I sell this company to my boss and his boss? People are ultimately going to write the check to make this investment. So to some extent, it's really I think we're all victims of the, in real estate in particular, there's probably 120 public REITs, maybe more than non-traded REITs, but it's not a very large universe compared to the public companies in general, but it's very well covered. I mean, the biggest companies probably have 25 research analysts who cover, like Simon Property Group is the largest real estate company in our space. They have 25 research analysts covering them. So what interesting and new perspectives can that 25th person add to the table that the other 24 haven't already done? So to some extent, the market itself almost creates this mean reversion in terms of how you're structured, the capital structure of the company, what you look like, what your geographic markets are. There's a lot of pressures in terms of, either be, as Tim mentioned, he's kind of in a national footprint, and you're probably more national than, because concentrated in certain geographies, but all over, from east to west. We're primarily East Coast company, but sometimes we get investors who say, we don't like you because you're concentrated in the Mid-Atlantic, and it's kind of slow population growth, good incomes, but not really, we don't really see a lot of growth prospects. We have other folks who say, we really like REIT because it's not all over the place, it's focused in a given geographic area. But again, you're trying to tailor your message to, the buying habits of the investors. As our new CEO said, for years we were trying to sell, using a retail analogy, blue sweaters, and everybody wanted a red sweater. So guess what? We're going to start selling red sweaters now, and it's, it may not necessarily be what we want to do, but if we want to continue to capture investment dollars, you have to give the investors what they want. So it's really a balance between giving them what we want and what they want.
And our history at UHS, we blend a lot of the things together that you're hearing here tonight. And just, again, to give you the history of the two companies, because I'm referring to both, but Universal Health Services, which is the hospital management company, started over 35 years ago. And from late 70s into the early to mid 80s, it was experiencing rapid growth. And what we were doing back then was buying acute care hospitals and operating them. And as you might expect, that takes a tremendous amount of capital. So UHS came right out of the gate as a public company and was utilizing debt for the most part to fund their growth. What happened then in the mid-80s is that Medicare changed the way they funded. They used to reimburse hospitals based on their cost. So if you said it took $5,000 for a 3-day stay to take care of a patient, that's what you would get paid. And what they decided to do at that time is they were going to put everybody's cost into a regional bucket and say we're going to pay you the average of that. So now all of a sudden the acute care business that wasn't all that concerned about cost became very much so, and it really slowed the growth prospects for UHS down because now you had a bunch of banks who were saying, I'm not so sure where this business is headed. So at that time, Bob talked about REIT being formed back in the 60s, but at that time REITs were becoming very popular again, kind of the mid-80s. So what UHS did was say, look, if we take the real property of some of our facilities and not the operating company, just the real estate, we'll put it into a REIT. The REIT will then be a public entity, and in effect, it swaps these properties to go public. And now we have a company that we pay rent to, takes a bunch of debt off of our balance sheet, and in effect gives us now the wherewithal to be able to grow. So UHT then, which is the real estate company, is advised by UHS, and those of us that work on the UHT side have roles on UHS as well. UHT then went out and primarily started investing in these medical office buildings that I referred to earlier. So UHS then just had rapid growth on the acute care side and more recently on the behavioral health side. Since the initial spinoff to UHT, UHS became an investment grade company. You really didn't need financing anymore. So for the most part, UHS doesn't have UHT own the real property of its facilities, but UHT owns a bunch of, either medical office buildings and UHSs are not related. But what UHT then did from the mid-80s to today was do, as Ed referred to, a couple of secondary offerings. So now it's this public company that to the degree we could finance growth with debt, we did. To the degree we needed to do secondary offerings, we did a couple. In 2001, we did, much like Pat was talking about, where we just went out and we hired an investment banker and did a big bang issuance, and you pay all the fees that go with that. You pay the debt down again to a degree that you feel comfortable in your total debt to capitalization. We continued to then grow. So a couple of years ago, and much of this, Pat also and Bob were talking about the cost of what you pay underwriters. And in addition to that, REITs, because you have to pay out 90% of your taxable income as dividends to stay qualified as a REIT, it's costly to have shares outstanding because you're just continuing to churn that cash out to dividends. So what we did on UHT side over the last few years is rather than do a secondary offering where we get a bunch of money in, some of which we need, some of which we don't, we started what is called an at-the-market equity issuance program. And essentially, that just gives you a bucket of shares to sell if and when you need them. And what it does is really just get blended into the day's trading. So when people are buying shares that day, some of them are buying shares from us that are newly issued shares. And you just get through the registration statement and all the things you need to relative to the SEC. But in number one, cuts down the cost. Instead of the 7 or 6%, we're paying 3%. And the other thing is, and probably more importantly, is you don't have outstanding shares that you're paying dividends on until you have a real use for those funds.
think if you boil down the question of what is the role of the investment banker, I think it's really pretty simple if we boil it down. So the investment banker's role in an IPO process is to figure out how to clear the transaction. So they're counseling the company on what you need to do to be prepared to be a public company. Here's how much I think your company's worth, and here's how much I think you can raise per share in an IPO. The investment banker's other role then is to find people that are willing to invest it at that price and clear the trade. If they tell you as a private company that they think you can raise X number of shares at $20 a share, and then you go and you're ready to do your IPO and it's only $16 a share, A, you're either not going to pull the trigger, you're not going to be very happy, they're not going to be in business very long if they can't deliver what they tell the private company they can deliver. On the other side of it, they're selling the securities to the REIT mafia that Bob alluded to people that are going to come to them and are relying on the investment banking firm to have an opinion on whether the business model works, whether the valuations are fair, whether they have the right people to run and maintain the value of the public company. So they really have a reputation to uphold to clear that trade and for the company then to trade appropriately for how everybody expected on both sides. So that's really what I think the role of the investment banker is to make sure that both sides understand what they're getting and then to deliver on it. They're not going to be in business very long if they disappoint one side or the other time after time. That said, anybody who is in a business that you get paid a commission, you'll always be able to find some service provider to take you public. You'll always be able to find somebody to sell your house without disclosing everything you want to tell the potential buyer about it. So there are good ones. Pat mentioned Jeff Horowitz. He's one of the best. He's been doing it forever and ever and ever because he's really good at it. I can give you 10 names of people that aren't very good at it. I mean, there are going to be good people and bad people at any firm.
Okay. Perfect time to pivot from the public and the REIT platforms where we're taking companies public or at least going to the markets of investors through investment bankers to get capital. Now we'll go to Eric's space, which is the real estate fund. Somewhat of the same investors, but a little bit of a different model. Eric, maybe you can share with everybody some of the issues regarding the process of capital raising, the private placement memorandum versus the registration statement, et cetera.
Yeah, so fortunately, at least we don't have to deal with investment bankers. We do something called a private placement memorandum. That's a document we draft up which outlines our economics, our deals with our investors. It's usually providing them with some return, 8 to 10%, their capital back, and then some kind of promote or carried interest, I don't know what we've used in class, to the general partner if we do a good job. So we raise under 2 different exemptions, and generally under 2 different exemptions, the Investment Company Act of 1940, 3C7 fund and the 3C1 fund. The 3C7 fund is only marketed to qualified purchasers. And so there's certain dollar amounts an individual or an institution have to meet to be that super class of investor. So it's generally for individuals $5 million in net investments, not counting your personal residence, and for entities generally $25 million in net worth.
So basically what that's saying is the investment acts are there to protect you unless you're wealthy over a certain amount, that they don't really care because they figure you can fend for yourself.
That's the concept. Who needs the higher level protection? And the SEC is all over the smaller investors, and they assume, rightly or wrongly, once you reach certain levels, you should be sophisticated enough or be able to hire people sophisticated enough to watch your money. So the other exemption is a 3C1. That's where you're raising from accredited investors less than 100 in that entity. So there's a slot count involved there. And the standards are much less. They're $200,000 of net income annually individually, or $300,000 if you're joint, or you have $1 million net worth, not counting your real estate. Now recently, our world has come under the purview of the Securities and Exchange Commission, and we all became registered investment advisors. And So now we have a third hurdle to get our investors over. They also have to be qualified clients under the SEC rules, which in general, and they just changed these, so these are approximate if I missed the latest amounts. And we're not in market, Liberty Adler's not in market, so that's the only reason why I can talk right now. I think the net worth got raised to $2 million, with, again, not including your personal residence. Or I think it's $1.5 million of assets under management with that advisor, and we never use that exemption, so that's not really relevant to us. So we screen all of our investors under those three categories, decide what entities they go into, generally set up partnerships that will co-invest in all of our deals. Some funds do use the equivalent of a investment banker. They call them placement agents, which have kind of gotten a real bad name because some of those have not been, I guess, really open and clear with the people they're marketing to, that they're getting placement fees. But we generally do not use placement agents, so we really don't have that fee. Now we have all the wonderful costs of lawyers and accountants, like my compatriots, but just not the investment bankers. The process, I think in all the capital markets, it's taking longer and it's harder to raise capital. In general, private equity funds, whether it's real estate or otherwise, you would have a first close where you get all the subscription documents from your investors, close those investors in, and then you'd have a period of time to kind of top off the fund. And it used to be hard, fast 12 months. Now you're seeing a lot of 12 to 18 month windows where you can have your fund. But we deal in close-end funds, so once you sign up and once we have final closing, those are our investors, and we use that capital over time to invest in the real estate properties. That's as quickly as I can get.
Okay, no hurry here. Okay, oh, good, Mike.
Can you talk about some of the challenges associated with and strategies you use to raise capital in, economic downturns from the private side of things?
It starts with the investor first mentality, and it's relations largely. Unless you use a big marketer like a placement agent, and the big brokerages provide some sort of placement. But for us, we have our core set of individuals that some of our principals have known for a long time, a group of individuals that have been loyal over these 13 years. And, if we want to get started in a new fund or an existing fund, they're generally willing to write, somewhere between $50 and $60 million of checks to get us started. Then the next important thing is, depending on what fund you're raising, what does it make sense for? And so our real estate funds were about 50% high net worth through our relations over time, and 50% institutional when we first started. And we had good relations with, the Pennsylvania teachers and school and the estate employees plans. But after you're somewhat successful, and after you get through Fund 1 and Fund 2, and you start going to Fund 3 and 4, the dollars really shift when the institutionals get better sight of your strategy, how you execute, and whether they really want to bank you. Then 80% of your capital is really coming from the institutional investors, and more like 20% is coming from your high net worth. And we're a little unusual. The high net worth individuals that have been with us from day one, we continue to include them, even though we know we could raise an entirely institutional fund. So we kind of have one foot in the retail market and one foot in the wholesale market. But it's challenging. I mean, you have to have performance, especially if you look from 10 years ago to now. It's a lot more numbers driven, a lot more screens. Most of the big institutions have advisors and consultants that will more than thoroughly vet, what you've done. The typical, we have to answer requests for proposals, RFPs, which, unanswered, they're about that thick, which, takes, weeks of data accumulation to respond to that investor. So as Pat said, you have a direct line to that investor, and when they want information or they want something, you are going to try and provide it. Of course, there's always, some reasonableness there. So I don't have a magic hat. You have to have good performance. You have to have top talent. And especially in this market, it seems like the way the private equity fundraisers is those that have made the cut are getting bigger, and those in second, third tier are having a hard time even making their next fund.
Okay, so we got through the formation stage. We've got our money now. We've got our capital. We know all about the capital markets. I'm going to skip over the debt markets, but now let's shift to going out and acquiring property, sector by sector. So I'll start with you, Chick. So in terms of UHRIT acquiring property, what do you do during the due diligence process to make sure we can get into the fundamentals or take it as far as you want? And I guess on the flip side, when you're selling property, what are you looking at from a protection point of view as part of the overall transaction? Then we'll hit every sector. Eric, then you can cover all of your sectors in terms of how you select your operating partners for investment.
Okay. Healthcare REITs, are actually in an interesting niche market right now because on the one hand, with healthcare reform and the things that are coming down the road, there's a lot of uncertainty, and uncertainty typically brings anxiety. But I think that at the same time, people recognize that the demographics continue to be favorable for healthcare, which means that we're all getting older, and that the demand for the services in the future will likely be greater than they are today. So therefore, medical office buildings and hospitals are things that generally people, there used to be a time where we used to use the word recession-proof, and nobody believes that anymore because volumes do get impacted when you hit tough economic times, but they're maybe recession-resistant to a degree because to the degree people have jobs, they still have insurance. So I think generally the business on the medical office building side has not dropped off substantially, but it has dropped off. So what we found in the last 2, 3, 4 years is that pricing necessarily on acquisitions of a multi-tenant medical office building, and generally the medical office building would be on the campus of a hospital, and in that building would be physicians that provide different specialty services, maybe an outpatient surgery center, a radiation center, a diagnostic center, just something that in effect supplements the hospital operations, and the proximity gives the physicians and the patients, what they like as they're able to go back and forth between the two. So that business, for the most part, still has strong fundamentals. And what we go after, and this is true on the UHS side too, we tend to try to gravitate towards areas that show above average growth, just shifting demographics. So as Bob referred to earlier, we're all throughout the U.S., but we're concentrated in many respects in Florida and in Texas and in California and in Nevada, because the populations before the recession tended to shift that way. And generally people were covered either under Medicare or they had some private insurance, so it was for the most part paying business. And when I say that, acute care hospitals on average before healthcare reform comes into place in 2014, 15% of the patients that present at an acute care hospital on average are uninsured. And when they're uninsured, unless there's state Medicaid funds there, you get nothing. So you don't generally see companies like us looking to develop medical office buildings in areas that may struggle economically because patients and the physicians, really their businesses aren't great. Financially, they're not able to meet their lease rental payments, and that's just an area that people have stayed away from. So what we generally do when we look at a property is we, besides the physical structure, we're really looking for the wherewithal and the ability of the existing tenants. And some of the guys here were talking about lease terms. They can range anywhere from a year to, say, 10 years for a radiation therapy center because of the improvements that you have to put into the space. But you get many 2, 3, 4-year leases of doctors and practices and things like that. So we kind of go in, we actually do tenant interviews with everyone. We kind of just get a general sense of what they think, what they're thinking when their lease expires, you know, whether they're happy with the general conditions. Assuming that all works out well, we do a financial due diligence just to make sure that the number is as represented. We certainly take a look at the physical plan to decide whether or not, in addition to the $10 million purchase price, if you need to put $3 million into the property because it's capital starved at that point. So once you do all that, you're really now kind of looking at your, number one, really the stability of the income going forward, because it's really that earning stream that you're paying for. And secondly, whether the purchase price, all other things considered, and your cost of capital, both on the equity and debt side, is a big part of that, whether or not the purchase price can service the way the funds that you're raising to pay for it and still in effect give a return to our shareholders through dividends. So the flip side of that, on divestiture acquisition or divestiture opportunities that we look at, those are made more on a, if any of the factors that I just talked about, when you're looking to go in, if you don't feel good about those long term, then many times you look at them out and you just sort of say, as Bob and some of the other guys were talking about, with a long term focus, I think that these questions always become very clear that if you're just quarter to quarter, then sometimes you're not really focused on what this thing might look like 3, 4, 5 years down the road. But when that's your focus and you see the developing trends, sometimes it makes the divestiture decisions much clearer.
Chick, who would you identify as your competition in that specific space?
There are, you know, I'd say maybe up to 10 healthcare REITs, but they're not necessarily the competition. Certainly, we're all out chasing properties, and that's what everyone does to fuel the growth. But what we find is there's private money out there. Before the real estate crash 5 years ago, physicians were becoming a huge competitor for us, because what was happening is physicians were running their practices out of multi-tenant office buildings that they were paying rent on. They're looking at the real estate explosion, you know, through the 90s and into the early 2000s, and they're going, why should I keep paying rent when I can own? And that became a real issue for us. So, you know, what we found, and this kind of follows up to your question, is that it really is the survival of the fittest now. So the companies that had the long-staying wherewithal to stay in business are the competition, but it's not kind of broad-based nationally. It's in pockets. So, you know, in this area, you might have a physician group, or you might have private real estate guys that are looking to get into the medical space, which has become pretty hot over the last few years. So, you know, I think it depends, Ed, on the markets you're in, but it comes from different areas.
Okay. Yeah, I guess there's probably two types of acquisitions that most real estate companies do. Portfolio acquisitions, which tend to be more strategic. You want to get into a new geographic area. You want to get into a different property type, so you go out and find a company or a private portfolio to acquire. And when you're doing a portfolio acquisition, I think you're still following some of the same basic tenets that Chick described. You know, you're doing business due diligence, checking and assessing the quality of the tenant base. You're doing physical and environmental due diligence. You want to make sure that the physical assets that you're buying don't require significant capital expenditures, or if they do, you can negotiate that as part of a purchase price, maybe a purchase price adjustment. And then for many of us, environmental. The last thing you want to do is walk into an environmental situation where there's significant environmental risk that you would become part of the chain of title, you know, by acquiring an asset. So we typically do. One of the first things we'll do is, you know, we'll start the business due diligence. All these things occur simultaneously. You know, we'll hire building engineers. We don't do any of this stuff ourselves. Typically outsource it. And we'll hire environmental consultants who will do environmental assessments of the properties. And you know, for the most part, you know, we're trading in institutional quality real estate. So the physical conditions, even if they're private operators, are generally well maintained. Typically, are not seeing a lot of environmental issues. So it really boils down to you know, the business aspects of the tenants and the market position, much like Chick described. And the one advantage we have in dealing with the retail space, particularly in enclosed malls, is you've all been through malls probably all over the the area, all over the country, and 85% of the tenancy tends to be national in nature. So if we see a property with a JCPenney or a Macy's or a Sears or a Gap or a Limited, et cetera, we can call our relationship folks at those companies and say, how does your store do in Springfield Mall? You're going to thinking about expanding. When the lease expires, you're going to close. So we can actually get intelligence not only from the seller but also from the tenants in a way that many other real estate property owners or investors can't get. So it's a combination of legal, financial, building, engineering, and environmental due diligence, and much more focused on those individual aspects when we're doing a single asset acquisition versus a portfolio, which those things are important, but not as important as trying to achieve the strategic objective.
In terms of the base due diligence, I don't care what sector you're in, you're probably doing most of the things that Bob already said, so I won't go through that again. But in terms of multifamily, what we look at, Bob brought up the idea of portfolio buyers. We have historically been portfolio buyers, and we're even more interested in being a portfolio buyer in today's environment, because when you get into smaller deals, if you buy a single apartment complex, if it only has 40 or 50 units, it might be $5 to $10 million purchase price. And if you can get the Fannie and Freddies of the world to lend you 80%, then all you have to do is go out and scrape up $2 million, which may seem like a lot of money, but you'd be surprised how many people can scrape up $2 million just from family and friends and piecing it together. So the competition for those deals is very significant, and it's generally, when you get down to that level, it's generally people that don't have much of their own money. So if I was going to do that myself, I might put $100,000 in and go raise 1.9 and complete that deal. But now, so I'm willing to bid up a little bit because I'm using debt, which is somebody else's money, and I'm using other investors, which is somebody else's money. And if all I want to do is get the deal done, I'll bid it up. Whereas when you get into buying $100 million or $500 million worth of apartment complexes at one time, the universe of people that are able to raise $150 million in equity starts to shrink. So we see the pricing become a little bit more disciplined and things not to get so out of hand. So that's one aspect that we look as we look and evaluate deals and get into acquisitions. And then the second is, as I said before, we are generally buyers of Class B, which is, in our world, that's 1960s to 1980s construction. And we like that for a couple of reasons. Number one, we believe that time period, the asset was built, it's just a better constructed asset. Eventually, all the Class A buildings that you see today are, 10 years from now are going to be Class B. Ours are still going to be Class B, but all the A's are going to be B's. And the quality of their construction is not as good. The footprint of an apartment unit that was built in the 60s to 80s, it's just a physically larger unit than it is for what they're cramming into current development today. And the last aspect of, sort of our, why we like that space is that it's generally, we feel very defensive against new construction, because if you build new construction today, it's going to cost you $200,000 per unit in order to build that, including land. And you're going to have to charge anywhere from $2,750 to $3,000 a month. Our average residence income is $60,000, and it's generally two people working in order to make that. And the rent is between $1,100 and $1,400. So even if you built, and in our infill locations, you can't build anything next door to us. You can only buy existing property. We buy at 60% of replacement value, and our resident base, while they may like to move down the street to that shiny new apartment building, at $60,000, there's no way that they can come up with $36,000 and allocate that to their annual rent cost. So we feel it's a very defensive position to be in our space to buy that. Now, the management of that is very different. As Bob said, the physical due diligence that we go through to make sure that we know what all the problems are and where the issues are, is critical for us in making that space. attractive to us. But last point, units built in the 60s to 80s, if they haven't been renovated, generally don't have a washer dryer. You guys probably don't even know this, but there used to be apartment buildings with laundry rooms in the basement. And there are still buildings out there that have that. We have, yeah, but those dormitories are nicer than our units. We have perfected.
Not the marketing guy.
Right. I'm just a realist. We have perfected, the ability to go and put washers and dryers, and it's unbelievable. It costs us maybe $2,500 to put a washer and dryer in, and we can charge $50 to $60 a month. That's like a 20% return, just cash on cash return. And we look at that as we'd love to see a portfolio of buildings that doesn't have washers and dryers and need to be rehabbed. And we look at that, and we'll be buying that stuff all day long.
It's a hard question to cover in a short period of time. It's a pretty complex question. For us, it starts with identifying the markets in which we want to acquire properties and grow in. Primarily, as with most real estate, you want to be in a market that has good barriers to entry. The worst thing that can happen in the storage business is to own a property and for somebody to build one right across the street, because it's going to take 3 years for them to lease up their property, and while they're doing it, they're just undercutting you on price the whole time. So you're looking at markets that generally have tough zoning. Northeast corridor is tough to get zoned for storage. That's good. So we focus on Boston down through Northern Virginia, parts of Florida, generally Southern Florida, most markets in Texas, Atlanta, Chicago, and coastal California. So if we boil down overall markets where we want to grow, that's kind of the first cut. The second cut is, in our business, in most geographies, our facility only competes against other facilities within a 1 to 3 mile ring around the property. So the underwriting from that point then is, so I pick a market, I find a property for sale in Boston. Now when you look at that individual property, I can't look at Boston now as an MSA. I need to look at that property and what's within that ring. And within that ring, we have a lot of different demographics we look to. We look at population growth, projected population growth, household incomes, how many people within that trade ring are renters versus homeowners. These are all things that tend to, wherever you are on that scale, provide a better long-term answer for us from a storage property. So we want to own properties where people make a lot of money, live in small spaces, and move around a lot. So those are markets where we're looking for. Once we identify a property that meets all those characteristics, then the underwriting is typically you're looking at physical plant. You're also, to Pat's point, in our business as well, we're looking for opportunities where we can have value add. So we look at what the in-place revenue stream is. We don't care about so much what the existing expenses are because we know what our expenses will be. Ours might be different than the existing owners. But we have tools that existing owners don't have in our business, because our business is nationally 15% of storage facilities, of which there are about 50,000 domestically in the U.S. Of those 50,000, 15% of them are owned by us and 3 other large players, and 85% are owned by smaller mom-and-pop or regional operators. And we can dramatically outcompete those folks because we have an internet presence and we have a better customer capture mechanism. So when we look at acquisition opportunities, we look to find a disconnect between market rates in which somebody is charging, and we can see an opportunity that we can charge more, kind of to the washer and dryer example. And so that's a lot of what goes into the secret sauce. For us, we'd love to find portfolio acquisitions because they're easier and you can deploy more capital quickly. The problem a lot of times in real estate is when you buy a portfolio, you buy a lot of stuff you want, and along with it comes a lot of stuff you don't want. And that stuff sometimes can really drag it down. You end up with a lot of properties in your portfolio that you kind of would rather not have, but they came with the portfolio. So that's an area of concern. But for the most part, we're looking at one-off assets that range from $4 to $10 million at a time. That's where one of your instructors, Ben, spends a lot of his time, but that's where we get the biggest bang for our buck.
Okay, so those are just sector-specific acquisition issues that they're looking at. Eric's funds have all kinds of money, and all kinds of operators are looking for capital infusions from you. And you go to operating partners to help select. So how do you select all your partners? And how do you select the sectors that you want to get into?
Well, let me start at a higher level, just to make sure we're all on the same page. So we invest pretty much across the United States, a little bit internationally, but we believe real estate's a local game. So what we try and do is we try and team up with an operating partner, someone who probably has a property management or other investment business in that geography and that type of asset. And that's the kind of person we want back. And we'll traditionally put in 80 to 90% of the equity for a new acquisition, and they'll put in 10 to 20%. They'll typically run the venture, but the first level of due diligence is our operating partners. They should be in that market every day, living, breathing, knowing every single building, and a lot of times even before it's on the market, they know exactly what they'll want to do with that property should we be able to obtain it. So those are the businesses we try and back and build, from small companies to much larger companies. And so a lot of the initial due diligence is done by that level. We are, again, across all different property types. Just to give you a few stats, again, at a high level, in the last 3 years, we've committed about $711 million of equity and 74 deals with purchase price roughly $2.5 billion. 60% of that has been multifamily. It's always been a great market for us, and especially in times like this, just a tremendous investment. The other next category, believe it or not, is 17% is in hospitality. We think the dynamics at this point in time are very good for
Guinness.
yeah. Anyhow, don't distract me. So 17% has been hospitality, but we're multifamily. Again, we look for the infill locations, urban, where you can't build across the street. So these are, more of your gateway cities, New York, San Francisco, LA, and such like that. We are starting to branch out now into some of the secondary markets on that. But the hospitality is all over the place. It's all over the country. It's if we have a great operating partner that has a great deal, usually not one of the big flags, more of an independent that we can do something with, whether we convert it to a flag or take it out of a flag if it's underperforming. But the other, 7 or 8% has largely been across distressed retail, office, and mixed use. So geographically, Texas has been big. We've done a lot of investing in Texas. The Southeast in general, everyone's been a distressed investor the last 3 years, at least in our world. And it seems to us the Southeast banks have come to reason faster than probably most of the rest of the United States. And so we've been able to negotiate pretty good. And again, to 2010, we were buying debt at some discount. Now we're working with banks and/or borrowers to work out their properties in some sort of equity infusion. The last category is there's been a ton of buildings in any space, whether you call it office buildings, and office buildings are tough. Every time a tenant rolls, you have a ton of tenant improvements you have to fund. So those aren't the steady cash cows some of these other businesses are. Every 5, 7, 10 years, you have to make a serious investment of that money back into that property. And what's happened is a lot of these owners have not been able to fund improvements, whether it's buildings, even where they have tenants willing to move in or take additional space, they don't have the money to fund the tenant improvements. That's an opportunity for us. And a lot of multifamily, people haven't been keeping up with maintenance. And once you get behind, you're dead. So those are some other areas we've hit. We always like New York City. We've done very well there. The Philadelphia area, we also have some good operating partners and good results. Florida and Illinois. Chicago is another great hub for us. But really, if you boil it down, it's the operating partner. You know, do they have the expertise? Do they have the execution skills to really run that property? Because if we can't take over a property and knock it down, rehab it, reposition it, it's probably not our deal. We're looking for very high returns. Maybe 25, 30% to net the right numbers to our investors in the opportunity fund space. So if we can't do a lot with that property, it's probably not our deal. Now,
The 25 to 30 cash on cash, like purchase, free and clear?
that's over the hold.
Okay.
So these days, which is a little unusual for us, we're going into properties, mostly multifamily, with a between 7 and 11% cash on cash return. That's not our historical business, but the prices are right and the buying opportunities are right for us to be in that market right now. More traditionally, the return is more weighted to when we do the refi. You say you hold a building, you run it better, you start getting the net operating income up, we'll refinance that property, take a lot of our equity out, and usually some profits. If, again, and our leverage is much less than Pat's. We usually are looking for somewhere between 65 and 70% leverage on our buildings. But then upon sale, we're hoping to net to our investors, 2 times equity. And so.
And that's really why we haven't done a deal with, and there's more than just, not to bring it up again, but. No, I mean, because that's been our problem is,
Here, David, do you want that?
there are a lot of opportunity funds that have the same philosophy. They're looking for those, high 20s in order to, so that they get that's how they kick into their promote. And our business model can, generate reasonably 15 to 18. And Mitch Morgan will tell you that when he was out there raising his first deals, he told them whatever they wanted to hear. Yeah, we'll get you a 25. And then, through cap rate compression, he was able to deliver that. But we don't do that anymore because, one, he's built up a substantial business, and we look at it from the standpoint, here's what we can deliver, and we have to go find the investors that want to look at that, because we are doing the same thing. We're 7 to 10% cash on cash, so you're halfway there. If you're at a 16 IRR, you're halfway there just on your cash on cash throughout the period. And the other thing that what we're seeing is from some institutional investors are that they are looking at that double promote structure where they invest with an opportunity fund and then the opportunity fund puts it out. They're actually looking that if they can find big enough operators at scale who go around the opportunity fund and get, a pension fund that is looking for an 8 overall to there are very happy with a 15% IRR, 7% cash on cash, and then we can hit into our promote, so we're happy with that deal as well. So, I mean, there is a bit of an evolving as to how the pensions are related to the opportunity funds and then to the operators.
Okay, so the pizza's here and it's smelling good. We're going to skip some of the agenda and just go to the finale. So we're going to hear the path from Chip, from Wildcat to wildly successful CFO, and then down the chain, share with them what they have to look forward to once they leave their college career.
I think as far as geography goes, my past 30 years has been wholly unimpressive. I came charging out of these halls and found an opportunity at UHS pretty much right after graduation. And I think the story, since I didn't travel to different places and live in different towns, but I think the story from my perspective is that sometimes all the change that you're hoping to find in your career could happen in one place. And when I started at UHS, we owned about 10 hospitals. Our revenues were about $250 million annually. The healthcare business then was much different than what it's become now. The REIT wasn't even thought about, and during that time, essentially we went from 10 hospitals to 200 and maybe 40 all in. The revenues are now $7.5 billion, and what that's really given the opportunity, not just for me, but for the 69,000 employees that we have nationwide, is it's given us all the chance to kind of grow up with the company. We actually had our employee holiday gathering today, and it's kind of an amazing story. Bob used to, I got to know Bob pretty much from day one. He was an auditor with Arthur Andersen, so we kind of grew up together at UHS before he left public accounting. And when we were giving out the employee awards at UHS, it's kind of staggering how many people have been there for such a long time. When they get to the 5-year and 10-year, 15, 20, 25-year runs for the people within our company. There are just a lot of them, and that is not only a tribute to the culture and the management of the company over many years, but it's really the growth and the opportunity that the business that we're in and the way it was run, and always with a long-term focus. The one thing that you heard a couple of the guys say tonight is that as a public company, you have quarterly targets, and there's a lot of pressure to meet those. At UHS, the founder was Alan Miller, who, we're a publicly traded company, but he owns less than 10% of the outstanding shares. He controls more than 50% of the vote. So it's a controlled company in a sense, and there used to always be a time where there was a knock the way our company would trade relative to stock price, because people said, even though it seems like a public company, it's not, because you have this one guy that can kind of dictate what goes on there. That over time has turned into a positive, because what it enabled us to do was not have necessarily that quarter-to-quarter focus, because he's not getting fired. And his view, which he's instilled in all of us, and which to me is the main message that all of you hopefully take out of here today, is that everything you do, keep a long-term focus in mind, because so much of the pressures and so many of the troubles that people get into, either financially or in a career path, is you see that jump that looks good today, but you're not sure what that means for somewhere down the road. And so much of the, certainly the troubles that we had in many of the markets, the real estate market, debt markets, where people were doing what intuitively didn't seem right, but it seemed like somebody was telling them it was okay to do. And long term, it almost had no shot, but short term, it was the thing to do. And we didn't get caught up in that. And so I think as you kind of think when you leave here, what your career is going to be, what your focus is going to be, and the way you then manage your careers, keep it long-term focused, because when you do, I just think it changes the complexion of the way you make those decisions.
Great advice.
Yep, good.
Okay.
Well, I had it's interesting to kind of look around, at least the folks up on the panel. I probably worked with many of them over the years, including some as clients. When I started my career, directly out of college, started working at Arthur Andersen in public accounting. My initial reaction was, I'm going to work here for a couple of years, get my CPA, and move on. And what I found is that the diversity of experience that I received, I guess, in my early years was that, hey, after 2 years, I didn't really think I'd gotten everything I needed to out of public accounting, so I kind of put myself on a year-to-year contract, and 23 years later, when I finally left public accounting, I had the experience of working with a lot of growth companies like Chick described. That was one of my first audit clients. I was involved with them. They spun out UHT. Chick and I had a wonderful trip when they were investing overseas to London together, try to straighten out a problem that we thought we straightened out. Then 2 years later, the company divested its UK operations.
You did such a good job.
But also having the experience to work with people like Tim and Pat, Ned, and Christina on a number of REIT IPOs. We had a very dominant real estate practice, which I guess is now part of the KPMG legacy in the Philadelphia market, where companies like Brandywine Realty Trust, that was a private company that started, I guess back in the mid-'80s, around the same time UHT went public. And that was a client that started with 10 properties, and the original plan for I guess it was Linpro Specified Properties, they were going to do a 10-property REIT every couple of years. They'd crank one of these things out. Well, it turned out the financial crisis that took place in the late 80s kind of put an end to that plan. But they retrenched, retooled, came back out very strong, and now they're one of the dominant office players, based here in Philadelphia. Again, my track from a career perspective was not unlike Pat's, who we'll talk about in a minute. I did a lot of work with real estate companies, and I did some work as well with healthcare companies. So I had kind of my feet in two different industries, very different. One very entrepreneurial. Chick's company aside, most of the healthcare companies in this arena, in this part of the country, are not-for-profits, and today they're again much different than they were 20 or so years ago. But I felt that I was always growing professionally, always had interesting and new challenges, so I stayed with it. And ultimately, when Arthur Andersen went out of business, I spent a couple of years with KPMG. And one of my clients for a long time in the public accounting world was Pennsylvania Real Estate Investment Trust. And I'd also done work with the Rubin organization. Ron Rubin, our recently retired CEO, was a private company that merged with PREIT back in 1997, and I happened to be the audit partner on Rubin as well as PREIT. So from 97 to really to the early part of the 2000s, I served on PREIT, and I rotated off because of the normal SEC rotation requirements. Then Andersen went out. PREIT had gone through a couple of major acquisitions. The then CFO came to me, who I'd worked with for many years, and said, "Look, I'm looking to take on a different role in the company. Would you be interested in joining PREIT?" And this was before any of the announcements of what they were planning to do were public. And I had known them for a long time, and the company had always talked a good game, but never could get anything done. So I said, "Ed, when you actually start to make some progress on getting these deals done, come back and talk to me." So one by one they started knocking these things out. And I said, "This is going to be an interesting opportunity." Around the time Sarbanes-Oxley was being rolled out, this was a guy who had an investment banking background and felt like a fish out of water. When the CFO role was becoming more process-oriented, more internal control focused, and so I had the opportunity to join PREIT 8 years ago. And through that time, we've had some very very high and very low lows. But it's been a really great learning experience for me to get to know the other side of the business. The one thing I always thought I knew with my public company clients is I thought I knew them very well. You don't realize how little you know until you actually step on the other side of that doorway, and now working within the company. But it's been a very good experience. I wouldn't trade my public accounting years for anything, but I think I reached a certain point in my career where I wanted something different, and I missed the client service part. I missed the relationship with people like Chick and others, but experienced new relationships, new growth opportunities, seeing the world from a different perspective. And I've, again, much like I wouldn't look back on my career years in public accounting, I certainly wouldn't trade the switch that I made 8 years ago for what I'm doing today.
Great. So first two guys have spoken, and they've had a total of 3 jobs. I blow that away. So they're the models of stability. I'm the models of instability, and most of it completely against my will. I graduated from LaSalle and started with a company called Laventhal & Horwath, which was a public accounting firm. It was probably, that was the days of the Big 8. That was the 9th largest. I thought I was very happy there. Same thing with Bob. I was in real estate and healthcare, and sort of progressing up the track. I enjoyed what I was doing. I had wonderful opportunities. In 1990, I actually moved my family to Sydney, Australia. We spent 1990 in Sydney, and during that year, Laventhal went bankrupt. So my wife had actually already come home. She called me one day and said, "You better get home because you don't have a job." So I came home, joined Arthur Andersen, sort of fell back into the same real estate and healthcare niche. Same thing, she looked at me like I was crazy because I said what I wanted to do was I want to get back into public accounting because I was really happy doing that, but I'm going to get with a company with a much stronger balance sheet, and this could never happen, and no client could bring down Arthur Andersen, so this is the perfect plan, and I'm going to make partners someday. And, much to my surprise, continued to work hard, progressed, and people like Bob and the leader of the real estate group in Philadelphia was a guy named Jack Salmon, brought me along, and I made partner in 97. And then the same thing happened in 2002. And at that point, I really struggled with, do I go for this again? Actually, the first breakfast we had with KPMG, the managing partner, who was, I was like 36, 37 at that time, came over and sat down next to me and asked me for my story, and he physically got white. I thought he was going to be sick when he heard that both of my former accounting firms had gone bankrupt. And, with all of the DOJ problems.
Technicality.
It was
Good things happen.
Good things happen, right. So that's what he was worried about. And from my standpoint, the game changed with Sarbanes-Oxley in terms of being an auditor. And what I enjoyed about being in public accounting was the fact that when you are working with entrepreneurial real estate companies and they don't have the deep resources in the accounting department, we actually got to do a lot of the creative work of what do you do to solve these problems. And when Sarbanes-Oxley came around, I got into a mode of saying, to guys that I used to work with and help all the time, well, why don't you give me a memo on what you think, and then I'll figure out whether I think the memo is right. And it just wasn't the same game. But I didn't want to make a move too quickly because it had taken me a long time to get to that position. So I, worked along for 3 or 4 years. And my piece of advice to you would, as Bob said, sort of, give yourself a year-to-year contract, but always have sort of a profile of what you would go to. And, I'd taken a lot of companies public, and I looked at that and said, that would be, CFO of a New York Stock Exchange company, all the comp perks and everything else that go along with that, access to capital, ability to do deals, that would be a job that I looked at. And actually I was called one day by a headhunter just looking for recommendations and ticked off the list, and it was exactly everything. And it was a company called GMH Communities Trust, which was based in Newtown Square. And I met with the CEO, met with the board. They ended up hiring me.
Spoiler alert, it went out of business too, didn't it?
We sold it. We sold it for
those allegations.
We sold it for. Well, I came in to fix the allegations, so I was on that. You don't want me to go through the whole story. It was sold, and actually a very lucrative transaction for the O'Grady balance sheet. And then I joined Morgan Properties, and hopefully, I expect this to be my last stop. But I think as I look back on, sort of all the network that I have developed by, being in all those different situations is phenomenal. There's only 8 people in the country that went through it twice. Once with Leventhal, and they were mostly managers at that point, who then went to Anderson and then became partners. So, I will tell you, it's better to go through it as a manager than a partner. But the network that I developed and the experiences that I had, I wouldn't trade, as Bob said, for anything. And they sort of gave me the skills and the background to be able to deal, sort of with, because I work in a company similar to Chicks, where there are people that have been in the accounting department for 15, 20 years, and they just don't have the breadth of knowledge about what's going on. So, they say, whatever generation this is now, the millennial generation, you're going to change jobs very frequently. I think you should do it. You should take advantage of opportunities when they're presented, but it should be part of a plan and part of building a skill set rather than just changing for change's sake. And that if you do have those experiences, build on those experiences, and then you can build it very creatively, whether you stay in 1 or 2 companies for your whole career or you do go through a lot of different situations.
So for the total opposite of planning and actually being thoughtful about a career path, I undergrad, Penn State accounting degree, went to work. So you'll see a trend here. Arthur Anderson as on the audit staff, and we went to like a national training back then in St. Charles. And when I came back, the first client that I was assigned to happened to be a company that now is merged into Bob's company. And I was assigned, just randomly picked out of a hat of people who started that day, that I got assigned to work on at the time was a REIT IPO. And I didn't know, somebody asked me, Tim, can you go fax this? And I said, I'm your man if you show me where the fax machine is and tell me how to work it. Because I'd never sent a fax before. So,
You might not know what fax is.
So So, as it ended up, at least,
Scary.
when I didn't pick the real estate practice at Arthur Andersen, it kind of picked me because my first assignment, I happened to be the person that was in real estate. So after that, every time somebody was trying to assign to staff a job, it was, I need a first year. Does anybody do it? Are there any first years that have real estate experience?
Tim is being too shy. He could run Lotus models like nobody's business. And none of us knew what to do with these things, so that was Tim's claim to fame.
Well, so I started to get put on other real estate clients and had been doing it for a couple of years. The staffing person came to me and said, I have I put you on this other real estate company. And honestly, I tried to get off of this engagement for about 3 weeks. I was in the guy's office every day saying, I'm building a pretty good portfolio of clients here, but I have larger clients. I mean, I was on the Preet engagement, I was on the Kransco engagement, which for us was a larger client, and I got put on this little rinky-dink thing that I was trying to get off of. But long story short, it turns out that was Brandywine Realty Trust, who at the time only owned like 4 or 5 buildings, and I on opposite of these guys, I ended up after only 4 years at Andersen, and having then been predominantly working on real estate work, as Brandywine started to grow, they needed to bring in some folks that had the skill set that you start to develop as an auditor. And so they recruited me at that point, and for me it was a wonderful opportunity because it was I wasn't qualified for the job that they hired me for, at least not a number of years on the planet. So I was very young and had an opportunity to get a role in what I thought was going to be a company that was going to grow. I spent 10 years at Brandywine, a host of roles from corporate controller to acquisitions, dispositions, financial planning. And during that period of time, just learned a tremendous amount about the business. Was chief accounting officer at Brandywine, and then ultimately had a great opportunity to follow the then CFO and my mentor over the last 10 years, Chris Marr, to CubeSmart and take all of those skills. And I told you I brought Ben, hired Ben as well, and we were trying to fix this other company. But sometimes you can have a great plan. Sometimes your career path just kind of happens, like Forrest Gump in the movie. But what I think is you have to, whether you have a great plan or whether you know what you want to do with the rest of your life right now, you always have to be doing something that you like doing. I always enjoyed what I was doing. You always have to work your tail off if you want to do well. That's an obvious thing, right? And words that I've always tried to tell myself is that everything that I do, dating back from when I was at Arthur Andersen, always try to spend a lot of energy trying to make everybody that's around you that you come in contact with better at what they're doing. Because I'm convinced that if you do that, you'll be wildly successful in life, whatever path you choose. Work hard, make everybody around you better, and before I'm just me and Eric stand between all of us and that pizza, I will tell you that one thing you obviously don't need to be successful, at least up to the rank of CFO, is you don't really need to be good looking by looking at this panel.
I don't think that.
We were something back in the 80s.